Imagine spending 40 years building a company, sacrificing your nights, your health, and your youth. Then, just 5 years after your funeral, it's completely gone. Not because of a sudden market crash, not because of a global recession, but because of your own family. This specific nightmare is exactly why wealth managers are quietly talking about the largest transition of capital in human history. Research firms like Cerulli Associates estimate that over the next 2 decades, an astonishing $84 trillion will pass down from older generations to their heirs. But behind closed doors, the people who built these fortunes are worried. They aren't sure the next generation is ready to handle what's coming. Honestly, I think their fears are entirely justified. Look at history. It happens to the best of them. When shipping and railroad tycoon Cornelius Vanderbilt died in 1877, he left behind a fortune worth roughly $100 million. At the time, that was more money than what was held in the entire United States Treasury. He was one of the richest human beings to ever walk the earth. Yet, within less than 50 years, the family empire had completely fractured. Massive spending, a lack of centralized financial control, and bitter family lawsuits tore the wealth apart piece by piece. By the 1970s, journalists covering the Vanderbilt family noted that the vast fortune had largely dissipated, becoming one of history's most famous examples of generational wealth decline. The greatest fortune of the 19th century vanished in just 3 generations. It sounds like an extreme example, but it isn't. Many wealth advisors frequently cite the idea that around 70% of affluent families struggle to preserve wealth into the 2nd generation, with even greater challenges by the 3rd. Think about that. Nearly 9 out of 10 family fortunes face significant decline over time. The real destruction is usually much quieter than a lavish spending spree. It starts with a total lack of basic financial literacy among heirs who grew up with abundance but never learned how to manage risk. Then comes the family infighting over who controls the board seats or the family business. Add high estate taxes to the mix, and a legacy collapses. There's a psychological shift too. According to wealth management surveys, a significant majority of heirs fire their parents' trusted financial advisors within months of receiving their inheritance. They walk into institutions like UBS or Bernstein Private Wealth, pull their money out, and try to manage it based on trends. They want to make their own mark, but without the right training, they usually end up making critical mistakes. Here's the thing that bothers me about how this money is moving right now. Younger heirs don't think like their parents. They aren't interested in holding traditional index funds or municipal bonds for 30 years. They want fast growth, and they want to invest in things that feel cutting edge. This is why we are seeing a major shift into private markets and alternative assets. Many family offices have increased allocations to private AI infrastructure, data centers, and digital infrastructure. They see traditional public stock markets as slow and overpriced. But here is the counterintuitive part that nobody talks about. By chasing high-growth tech trends and speculative venture capital, these heirs are taking on massive operational risks that their parents intentionally avoided. They're trading long-term generational security for short-term tech excitement. The founders of these fortunes see this trend happening, and they are fighting back. Not by cutting their kids out of the will, but by changing how the money is structured. They are increasingly separating actual ownership from daily decision-making. Instead of leaving money directly to an individual, they are locking it inside multi-jurisdictional private trusts and family foundations. The heirs get the financial benefits, but professional boards and trustees make the real investment decisions. It's a legal shield designed to protect the capital from the family's own bad habits. And this protective strategy is changing global geography. Look at the latest numbers from wealth migration reports. Tens of thousands of affluent families are completely relocating their legal structures. The UK, for instance, has seen an unprecedented outflow of millionaires over the past couple of years. Many of them are moving their family hubs to places like Dubai and Singapore. Why? Because these hubs offer highly stable legal frameworks for trusts, alongside favorable tax environments. For many wealthy families, Those features make these jurisdictions attractive for long-term estate planning. Now, you might be watching this thinking, this is a great story, but I'm not inheriting a multi-million-dollar estate. How does this apply to me? It applies because the rules of wealth don't care about the size of your bank account. The exact same traps that destroy billionaires can destroy your family's financial future too. If you want to build wealth that actually lasts, there are 3 practical rules you need to implement right now. First, teach financial literacy long before you pass down assets. If your kids don't know how to budget, invest, and handle risk when they have $10, they will destroy $10,000. Second, build systems, not just a savings account. Use wills, basic trusts, or clear legal agreements to define how your assets should be handled. Don't leave room for your family to argue later. And third, diversify your mindset. True security isn't just about picking the right stock or buying one property. It's about protecting what you already have from emotional decisions. We spend our entire lives grinding, working 50-hour weeks and sacrificing our time to build a financial foundation for our loved ones. But if even some of the world's wealthiest families worry that their legacy may not survive a single generation, why are you so sure your current strategy is enough to protect yours? Wealth isn't just built, it's preserved. And history suggests that's the harder part. I'll see you next week.